Welcome everybody. Welcome back or welcome to Sectors Made Simple. Today we have a very topical conversation. Tomorrow, and really today as well, are the FOMC meeting for September of 2024. And we're expecting some major announcements about where federal interest rates are going from here. But I just used a bunch of terms that you might not be familiar with. Federal Reserve, federal interest rates, and most importantly, how do these impact you? We'll take a look at all of this in today's webinar. So let's just dive straight in. Really quickly, we got to go through a disclaimer. Basically, remember that the goal here isn't to give you financial advice or tell you what to do with your money. It's to talk about observations and facts that we see, provide some input or some opinions, but remembering that those are just that, opinions. I look at a bunch of data to come up with those opinions, and I encourage you to look at that data as well. Make your own decisions when you are investing or doing anything when it comes to money. Cool. Now let's get to the fun stuff. The goal for today's webinar is to talk about what is happening today, and more importantly, the decisions that will come tomorrow. Tomorrow is going to be a very important day for the U.S. economy, because U.S. interest rates are expected to decline for the first time since 2020. And as a result of these elevated interest rates, U.S. inflation has been brought back under control. This whole idea is kind of circling around a common theme, which is known as a soft landing. But don't worry, we'll take a look at what that actually means today. But the most important thing, and hopefully the reason why you're here, is why does this matter, and most importantly, why should you care? Are interest rates dropping a good thing for you? And again, should you care at all? The answer to both of those questions is ultimately yes. So if you're here to know those answers, there it is. But if you want to learn more about why the answer is yes, or at least is mostly yes, stick around, because there's a lot of great information for us to cover. So, speaking of, let's take a look at what we will cover in today's webinar. We're going to cover how inflation works, two of the most common ways that it's calculated, and look at the similarities and differences between them. We'll talk about what the Federal Reserve, or more commonly known as the Fed, is. We'll talk about the federal funds rate and what that is. We'll talk about how the Fed uses the federal funds rate to try and address issues in the U.S. economy, namely inflation, and what we know right now leading into the second day of the FOMC meeting, and more importantly, how this meeting will change federal funds rate in the immediate future and how it might impact the federal funds rate in the more long-term future. And again, bring it all back to answering why you should care. Let's get started. The best place for us to start is to talk about the reason for the federal fund rate changes that we've seen over the past 2 years. Inflation. Inflation is a basic economic idea that just says how much stuff your money buys you will go down over time. You probably have heard your parents go through back in my day, burgers were 5 cents and a gallon of gas was 2 nickels. Yeah, that's how it used to be. Now, if you manage to find gas for 10 cents a gallon, I'm pretty sure everyone would be there, because they're essentially giving it away. The value of money, or how much stuff, the buying power of that money, declines over time. And that's intentional. Inflation is shown as a percentage. So you will see inflation has changed by 5%. What that means is in whatever period of time that is that we're looking at, how much stuff you could buy a year ago to today has changed by 5%. So the value of that money has gone down. Inflation is a number or a percentage that we can use to compare these prices. Typically, the most common ways of using inflation are comparing today's prices to the prices 1 month ago and 1 year ago. So, again, in the interest of, if you're just here to get some answers, giving you the answers you're probably curious about, Is inflation bad? Is this the boogeyman of the US economy? And the answer is kind of. Now, inflation isn't entirely bad. It's not the thing that we need to avoid at all costs, and any inflation is bad. Ultimately, a little inflation is good. A little inflation means that all of us know our money is going to be worth less tomorrow than it is today. So we're more likely to spend it. You know, we're going to go out and buy that good deal on Black Friday, or we're going to go and purchase that new winter jacket, because we know next year those things are going to be more expensive. So inflation is a tool so that people like you and me want to spend money so we get more bang for our buck. But too much of a good thing is indeed a bad thing. So too much inflation is undoubtedly bad. Because if inflation is rising too quickly, we're not likely to spend our money. We're more likely to not spend our money. Because we know that our money is not going to buy us as much, and we're more concerned with spending money on the things we need as opposed to the things we want. So again, inflation, mostly good, but not always. And honestly, in the past few years, inflation's been out of control. So, in the context of where we are in September of 2024, we can just say inflation's bad. Inflation is bad, but has gotten better. We'll come back to that in a little bit, but first let's talk about what numbers we can use to define inflation. Because inflation is the idea, but not the metric itself. For that, we need to look at the Bureau of Labor Statistics, or the Bureau of Economic Analysis, BEA or BLS. In this case, we're looking at the BEA, who defines two different inflation metrics. The first is called CPI, or Consumer Price Index. This is, again, just a number that's used to explain how much the cost of stuff has gone up compared to last month or last year. Its sibling is known as the PCE, or Personal Consumption Expenditure. Both of these numbers tell us inflation, but they do it in different ways. And depending on who you ask, they might say, I prefer CPI over PCE, or vice versa. So let's quickly talk about both and look at how they're similar and how they're different. Starting with CPI. This, I would say, is the most common of the two inflation metrics. If you ever read a news article and they mention inflation, I can almost guarantee you that they are talking about CPI. It's recently been the bigger number. When we talked about how high inflation got, we didn't look at PCE. News outlets were reporting on CPI. So CPI looks at the average cost of urban consumers, people in cities, and looks at how much they're paying for a variety of things. In total, CPI includes over 94,000 different prices. And again, this is the most commonly used metric by the public, people like you and me, but also news outlets. We can break up CPI even smaller, so that we learn about different key things that we are spending our money on. The first is known as headline inflation. This is everything thrown into a single number. And typically, it's going to be the number that changes fastest. Why? Because the price of certain goods or certain items is more likely to change because of the season, because of different global events. There are many different factors that go in, and some are more volatile than others. The most volatile two are energy and food. I don't think I need to tell you, because you probably experienced it. Let's just think about the price of a carton of eggs over the past 4 years. The price skyrocketed from like $3 for a dozen up to $7, and then has gone back down to around $4 to $5. So the prices that we pay for groceries, milk, eggs, cheese, meats, those can change very, very quickly and are subject to a lot of supply and demand issues. This idea that if there's not enough supply or too much demand, looking at you holidays, those prices will change way faster than they have any right to. The second is energy. In the winter, we're more likely to need to heat our houses with gas. In the summer, we're more likely to need electricity to power our ACs. So really, energy changes dramatically based on the season. These two different industries are extremely volatile, and because of that, while inflation including them is nice to know, it can also be helpful to leave them out and look at what is known as core inflation. That is, all inflation, forgetting food and energy. So, CPI is broken down mainly into two different groups. We have headline inflation, which is everything, and core inflation, which is everything except for food and energy. If you really want to get down into it, and honestly, if you're interested, I recommend this, dive into one of the CPI updates that the BEA provides, because they don't just break it down to all items, core, food, and energy. They go through every one of the categories and show you how that one category has changed. It's super, super interesting. But that's more detail than we need to go into for today. So we'll sum it up by saying CPI is urban consumers and how much they pay for everything and for just core inflation as well. So now let's look at PCE. PCE is considered to be a little bit more inclusive than CPI, mostly because it includes not just urban consumers, but rural consumers as well. In fact, it includes so much that estimates put it around 66 or 2/3 of the total spending of the United States. So of the two between PCI and CPI, PCE, trust me, you're saying these two terms as much as I am, you're going to mix them up every now and then. But PCE is much more inclusive and captures a much larger group of spending prices. But again, they are slightly different. PCE favors certain things more than CPI does. For example, in CPI, almost 30% of the CPI is because of housing prices. PCE, that number is less than 15%. So it's less than half of the value. So where does that value go? Places like healthcare, financials, so how much it costs to borrow money, and recreation as well. So slightly different calculations, but both trying to get at the same idea. How much are prices going up? And once again, PCE and CPI both follow the same idea, that we can break up two different important metrics. All prices and core inflation as well. All prices minus food and energy. The most important thing for us though, because again, do I expect you to know the differences after this? No. Might be a cool trivia question one day. But ultimately, the reason that I'm covering these two different indicators is so that you know most people are going to think about CPI because that's what the news is going to report. That's why it's called headline inflation. But ultimately, the people that really matter right now and the big talk of the town is the Federal Reserve, and they prefer PCE. So let's dive into the Federal Reserve a little bit and talk about who they are and more importantly, what they do. The Federal Reserve is known as the central bank of the United States. They are the people that sit at the top of our banking and financial system here in the US. And, contrary to popular belief, they are not a US government branch. Instead, they are an organization that was created by Congress back in the 1910s to help monitor and help steer the direction of the US economy. The Federal Reserve is a national group, but to help make their job a little bit easier, the Fed is broken up into 12 regional Federal Reserve branches. Each one of these branches manages all of the banks within their specific region. If you're interested, you can find a map online of all of these different branches. But the thing we care about today is not those 12 different branches. Instead, we care about the council that sits at the top of them all. This is known as the Board of Governors, or commonly known as the Federal Open Market Committee, or FOMC. They are the people that we care about, and they are the people that we should focus on. Because the Fed is a group, but the FOMC are the real policymakers for the United States. This group meets 8 times per year, or twice per quarter, and in these meetings, the Fed looks over all of the economic data that they have access to, and they decide if and how they should get involved in the US economy. They have a number of goals and a number of tools, but we're just going to focus on one goal and one tool today. One of their tools that they use is called the federal funds rate. And their goal is to use this rate to address key pain points in the US economy, primarily inflation. So let's just summarize this by saying the goal of the FOMC, and by proxy the whole Fed, is to change the federal fund rate to help tackle inflation. So, we know what inflation is, we know what the FOMC is. Let's talk a little bit about the federal funds rate. The federal funds rate, or Fed fund rate as it's often shortened to, is again one of the key tools that the FOMC has to try and correct or direct the US economy. This federal funds rate is not a rate that you or I ever really get to see. Instead, it is an interest rate that banks use when they're lending to other banks. There's such a thing known as an overnight loan. It sounds really silly. Why would a bank need to borrow money, right? Aren't they supposed to be the people lending us the money? Well, in reality, the Federal Reserve does more than just set the federal fund rate. They require that banks have a certain amount of cash in reserves, so if people need to withdraw their money fast, they know that there is a lot of money there ready to access. So, to meet some of these requirements, it is very, very common that Chase will lend to Bank of America, or JP Morgan, I guess JP Morgan and Chase are the same people now, or Citibank lends to Chase. This happens all the time, and is happening probably right now. So this overnight rate just sets how expensive it is for one bank to borrow or lend to another. They don't get to decide what it is, the federal fund rate does. Typically, the federal fund rate is set at a single number, but in reality, that number will vary. So if you see the number is 2%, in reality, it's 1.75% to 2%. But all of that's to say that if it's more expensive for a bank to lend to another bank, that means it's going to be even more expensive for people like you or companies that you might see to borrow money as well. That is the goals of the federal funds rate. Make money more or less expensive to borrow. We'll come back to that though. I want to show you the real impact of the federal funds rate, because again, it's a little tricky. It's like the Wizard of Oz, where there's this magician standing behind a curtain, pulling all the strings, and you never get to see them. All you get to see is the big face that you actually talk to. So, let me show you both sides of that curtain. To do that, we're going to take a look at a 30-year fixed-rate mortgage loan with good credit. Let's break that down. I want to buy a house. I want to pay off the money I owe on that house over 30 years. I don't want the interest rate to change. And I've got really good credit. My risk of not paying is pretty low. This is about the best case scenario that you can get beyond the 30-year part. But let's take a look at what that percentage might look like. If this was January of 2021, the Fed fund rate at the time was 0.0%. So there was no federal fund rate. With that 0.0%, the mortgage rate, the fixed rate that you would pay throughout that entire loan, was 2.9%. Pretty good, right? Borrow money for 3% interest per year? Sign me up. So where is it today? Well, the federal fund rate, big spoiler here, is not 0.0% anymore. In fact, it is now 5.25 to 5.5%, which means that it costs a bank 5.25% to borrow money from another bank. So do you really think if it costs a bank 5.25% interest, they're still going to give you that 3% interest rate? No chance. So what is it? Well, if you look back in October of 2023, mortgage rates hit the highest point that they've been since COVID, and the rate capped out at 7.9%. So, in just over 2 years, we went from a 0% Fed fund rate and a mortgage rate of 3%, and now, because we've tacked on that additional 5.5% Fed fund rate, that rate is now 7.9%. So from your side of things, if you wanted to buy a house in January of 2021, you would have gotten a 3% interest rate. If you wanted to borrow money to buy a house in October of 2023, that would have been 7.9%. That results in hundreds of thousands of dollars of difference for what you have to pay back over the lifetime of that loan. And that 8% interest rate doesn't change unless you refinance or if you have a variable rate. So if you don't choose to do either of those things, you're stuck with 8% for 30 years. That is a crazy idea and hopefully shows you that the federal interest rate can be a little bit spooky. But keep in mind that this example was looking at buying a house and borrowing money to buy a house. But the same idea, the same federal fund rate impacting and skyrocketing other interest rates happens for all types of consumer, but also business loans as well. So, how does the federal fund rate impact our economy? Well, this should be pretty straightforward. If money is more expensive to borrow, that means that companies aren't going to make as much money. If companies are still needing to borrow money and borrowing money is more expensive, companies' profits are going to decline. Well, now companies aren't as likely to invest. They're not saying, oh, we've got a bunch of cash sitting around, let's throw it at a new project. No. They're starting to look at how they can save money because they know it's way more expensive if they need to get more. But also, declining profits has another side of the conversation. If a company isn't making as much money and they know that they can't change how easy it is to get more, they're going to start trying to cut back their spending. What better way to cut back spending than to cut back employment? So companies will begin to lay off employees, and as a result, that means that people are starting to lose their jobs. When people lose their jobs, they don't have the money they need to support their family. Or if they have the money to support their family, they probably used that vacation fund to try and do so. So now, people are spending less money. They are trying to cut back on their spending as well. They're not going to go for that vacation. Instead, they're going to go for a road trip or go for a hike or go camping. They're not putting as much money into the economy, and instead, they're spending money on the things they need. And don't forget, this whole time, inflation is still affecting us. So the cost of what we need to buy is going up. The amount of money we're making is going down. And both of these things are happening at the same time, making the entire situation worse. So, let's bring it full circle. If companies are making less money and are laying people off, People losing their jobs means they're making less money, so they're not going to put as much money into the economy. All of that comes full circle to say companies are now making even less money. They're starting to lose money. This whole cycle has a name when it happens at a large enough scale. It's called a recession. Recessions are not the main thing we should talk about today. So we're not going to focus on this for the entirety of the session or for the webinar. Instead, I just want to quickly summarize the things that do matter to us, where we are September 2024. A recession is a period of economic decline. It is typically pretty short, with the average duration lasting around 6 to 12 months, the actual average 10 months. In a recession, we will see unemployment spike, the amount of consumer spending decline, people beginning to default on auto or home loans. Essentially, they can't pay for their house anymore because they're not making enough money. And that then results in a lot of issues. But there's one positive effect. Inflation decreases. Because again, inflation is happening because people are putting a bunch of money into the economy. So prices are going to go up. If places can charge more for the same amount of stuff, why wouldn't they? So when a recession happens, all of a sudden, spending goes down. Companies have to lower their prices so that people want to buy them. Lowering prices is the definition of inflation. So one of the main benefits of a recession is the fact that that inflation drops dramatically. But at what cost? Because again, the Federal Reserve, let's go back to them really quick. If their goal is to decrease inflation, we have to ask at what cost are they willing to do that? Obviously, a recession causes significant hardship to companies, but more importantly to us. People losing their jobs is a really bad thing. People losing their homes is even worse. Recessions are horrible events. And the Federal Reserve, they're not evil. They don't want to cause a recession. What they want to do is get inflation back under control. Because as we said before, we're kind of stuck between a rock and a hard place here. Too much inflation, really bad thing. But you want to do something about that inflation? Don't cause a recession. They're stuck in a lose-lose situation. Try and lower inflation, you risk a recession. Avoid a recession, you cause inflation to skyrocket. So, at a certain point, we need to make a decision. What's worse? Inflation skyrocketing out of control with no end in sight, or a recession that is devastating, but has an end, and eventually has a recovery. We've had recessions, and the more extreme example of those are depressions. But the US economy has always recovered and has built back stronger. So, here, recessions are typically seen as the necessary evil and is just a part of the process of trying to tackle inflation. The Fed has a goal. Because again, before I said inflation is a good thing in moderation. So the moderation point for the Fed is to keep PCE inflation between 2 and 3% annually. So, what's the Fed's track record like? Well, over the past 100 years of the Federal Reserve existing, they've only managed to get inflation back under 3% without triggering a recession one time. Every other time they've tried, whether intentionally or unintentionally, they've caused a recession, or a recession has followed. The Fed is not the single reason for a recession. So this event, this idea of getting inflation back under control without triggering a full-blown recession, is known as a soft landing. Why? Because there's two ways that we can have an egg land on the ground. A really nice big parachute, or we just chuck the thing at the ground and we don't care if it goes splat. One is a soft landing, the other is a hard landing. I'll give you an idea of which one's which. But What I'll say right now is that the Federal Reserve doesn't always try and cause a soft landing. But this time they did. The Federal Reserve wanted to tackle inflation, but do so through a soft landing. So, how likely is that? Is a soft landing for the economy in September of 2024 possible? Unfortunately, I can't give you a great answer because we're still living this. We are right now experiencing the end of a heightened period of inflation. So where we're at right now is that we've squeezed something really, really tight. And we're just about to start letting go. Does that mean that there's not still pressure on that thing? No, there's still a lot of pressure. All we're at right now is the first little loosening. There's still plenty of time for something to happen. So I can't give you a concrete answer because we are talking about and discussing events that are literally happening today and tomorrow. So instead, what we can do are look at the same signs and indicators that the Federal Reserve is. And look at, are those signs pointing to us moving into a recession or avoiding one and truly seeing the first soft landing of the 21st century? Well, to keep it easy, there are two things we're going to look at for a recession. A sharp decline in inflation and a spike in unemployment. And a third lesser fact as well, which is originally the old school technical definition of a recession. 2 consecutive quarters of GDP losses. So, are these factors present today? Let's start off with inflation. PCE inflation, again, that's the one the Fed cares about, peaked at 7.1% in June of 2022. Since then, it has steadily declined, and in July of 2024, the reading for the PCE inflation year over year was 2.5%. That falls well inside of the 2 to 3% window the Fed is targeting. The second is unemployment. Has unemployment skyrocketed? Well, let's look back at previous recessions. The US has never left a recession with an unemployment rate below 5%. Most recessions result in 8 to 12% unemployment. Now you see why I'm talking about. If we go from 3, maybe 4% unemployment up to 8 to 12, that's massive. So the US has never gotten out of a recession with an unemployment rate below 5%. Currently, the unemployment rate is 4.2%. So, inflation has already dropped. Unemployment is still keeping well below 5%, which would make it by far the lowest lowest unemployment that we've ever seen in a recession. So, the last thing for us to look at are the GDP losses. And there were 2 consecutive quarters of GDP losses, which does meet the definition of a recession, but those happened before the interest rates started spiking. In fact, they happened between January to July of 2022, quarters 1 and 2 of 2022. Since then, and by the way, since then is when the Fed started increasing interest rates, GDP growth has been positive. So, inflation has been brought back into acceptable ranges. Unemployment is well below the 5% line, and we have not seen, since federal interest rates started to rise, 2 consecutive quarters of GDP losses. So, is a soft landing possible? It's looking pretty darn good for that. Before we get into the next part of this, there are some questions in the chat that I want to answer. How does the market react to each of these economic cycles? I will cover that. Great question. How long do you think it will take for a change? Also a great question that I will answer in this presentation to a certain extent. I do want to answer that one right now, though, because again, it's not perfect. How long do you think it's going to take for a change? I think we've seen the majority of that timeline already. In fact, I'll show some data to prove that what we are seeing right now is incredibly weird as far as how long federal interest rates have remained high and how long the Fed has waited to lower these rates. So how long do I think it's going to take before we see a change? Tomorrow. It's an almost 100% certainty that we see a rate decrease tomorrow. By how much is a different story, and if more or less is a better thing, different story entirely. And we'll take a look at some evidence to support that. What is worse, or what could be worse, inflation or a recession? Great question. Let's take a look at that. By answering the question, do we want a soft landing? What is better, inflation or recession? So, do we want a soft landing? Yeah, but also no. Why? A soft landing primarily means that people aren't losing their jobs. The economy isn't collapsing. Banks aren't failing left and right. Sure, some banks have failed. That's an inevitability. What we are experiencing is called economic pullback. Basically, we're just pulling things back a tiny bit. But we're not seeing a recession, and we're definitely not seeing a depression. Again, this is a whole scale here. So, we're on the more moderate side of that scale. So ultimately, less people are losing their jobs, less people are losing their cars, less people are losing their homes. As far as I am concerned, and most consumers are concerned, and probably you are concerned, soft landing is a good thing, and we do want that. But at the same time, a soft landing means that inflation doesn't change as quickly. What that means is it takes longer for inflation to get back under those acceptable 2 to 3% levels. So we feel the pressure of the economy a lot longer. While this topic is something new that I'm discussing for everyone here on YouTube, the topic and the question of are we seeing a recession, are we in a recession, are we going to see a recession, have been topics that I've covered with Sectors Made Simple subscribers over the past 2 years. So we've constantly looked at whatever data we had available to us at the time to answer the question, are we in a recession? And the answer's always been no. But the fact that I'm continuing to have this conversation is a clear sign that we are feeling the pressure, we're asking this question, and we have the worry for much longer than we have before. So, Romulo asks, what could be worse, inflation or recession? I want to ask you the same question, but through an analogy. You got a Band-Aid on your arm, and you know you got to rip it off. You know it's got to come off somehow. What would you rather do? Take it off slowly? It's not going to hurt as much, but you're going to be feeling that small amount of pain for a lot longer. Or, you take a deep breath, and rip that thing off as fast as you possibly can. Soft landing, hard landing. Except instead of a Band-Aid, it's the entire US economy. In my opinion, I would rather have a soft landing. I think that the real lasting damage, while a recession itself does not last for an incredibly long period of time, the damage that a recession causes does. That leaves lasting impacts, damages many American families, and ultimately causes so many issues. Is there a perfect solution? No. You've got a Band-Aid on that needs to come off, and there's going to be discomfort either way. But I would much rather have it where the pain is there, but is manageable, as opposed to the pain being almost unbearable, well, if you're me, unbearable, for a short amount of time, and then having that stinging feeling left over on your arm. Again, we're not playing around with a Band-Aid in real life here. We're playing around with people's jobs, people's ability to support their families, and in many cases, their houses. Thinking back to the Great Recession of 2008, unemployment spiked well above 10%. Hundreds and thousands of people were losing their homes. Banks were failing. That is an borderline economic collapse. the damage that caused took years to recover. There's a reason that it's called the Great Recession. So, a short amount of discomfort that we are able to course correct pretty quickly from, versus ripping off the Band-Aid and having that stinging feeling, or in terms of the economy, for years. I would rather take the slow, less painful approach. We don't have enough Band-Aids. I agree. Alrighty. That's where we're at today. Let's quickly set the tone for where we go from here. How did we get to this point, and where do we go? Well, the federal fund rate began to change back in April of 2022. Why? Because as I mentioned before, inflation, one of these days I'll actually get those two correct. Inflation was sky high. We were nearing 9% for CPI inflation and over 7% for PCE inflation. Part of the reason was because of the massive stimulus of money that was put into the economy during and after the big events of 2020 and 2021. People had to change their jobs or lost their jobs because of the global events, and that meant that the US needed to step in to avoid an economic collapse. So they did. They started providing people a lot of money. Did it save many families? Yes. But what it also did was put a ton of cash into the US economy and rose inflation extremely, extremely fast. So, to try and tackle that, the Federal Reserve began to increase the interest rate in April of 2022, and over the next year and a half, by August of 2023, this rate had risen from 0 to 0.25%, up to 5.25 to 5.5%, where we stand today. And again, that's where it's been. So, where do we go from here? Well, let's look at what's going on right now and talk about how normal what we're seeing is. Spoiler alert, it's not. Check this out. Right now, this is the longest amount of time that the federal interest rate has remained unchanged. Since the data collection began back in 1950, this is from the St. Louis Federal Reserve. This is the longest period of time that we have had the federal fund rate unchanged. It's not gone up, it hasn't gone down. Also, it is within 0.25% of the lowest rate that we've seen that has actually addressed inflation, recession or otherwise. The best we've ever seen was the last recession that we experienced back in 2007, where the federal interest rate was 5 to 5.25%. Inevitably, we all know how that ended. There was a massive recession, but the point stands of we are super, super low. People think a 5.25% federal fund rate and an 8% mortgage rate is crazy high. If you want a little bit more detail, go look at a historical graph. You know what? Let's do it together. Let's go check out the federal fund rate chart, just to show you that what we are experiencing right now is not that bad. So, from 1954 to today, here's where we're at. Here was 2008. All through the 80s, it was very normal to see a federal fund rate well above 5%, even as high as 19%. The only reason why it seems weird is, let's look what's happened recently. 2003, 1%. After the Great Recession, that stayed at 0% for 6 years. After what happened in 2020, another almost 2 years of 0%. We've gotten very, very, very used to the idea that 0% or low interest rates, like low single-digit interest rates, are the new normal. I hope they're the new normal, but you've got to remember, in the context of the federal funds rate and its history, we are still seeing extremely low rates. So this is the lowest rate or almost the lowest rate we've seen that's actually addressed the issue of inflation, as well as if we do get out of this without a recession, this is the largest decline of inflation that we've ever seen without a recession causing that or being a result. So, what we are seeing right now is very strange because the Federal Reserve is trying to pull off a soft landing. And it's looking pretty darn good that they're going to be able to do that. What we're seeing here is just the result of that. These are just the little indicators that we can see to show that what they're doing right now is not normal. And that might be for the best. So, again, let's stop beating around the bush. Let's answer the big question. When are federal interest rates going to go down? Simple answer, tomorrow. As we mentioned earlier in this webinar, changes to the federal funds rate happen during the 8 annual meetings of the FOMC. And today, September 17th, and tomorrow, September 18th, are September's FOMC meeting and are the second meeting of quarter 3 of 2024. After tomorrow's session, the Fed will announce what their change to the federal fund rate will be. There is a tool offered by CME called the Fed Watch tool. It looks at the probabilities or forecasts or where federal interest rates will be at the end of different FOMC meetings. They don't just forecast the upcoming meeting, they forecast about a year into the future. But let's not worry about that. Let's look at tomorrow. Current forecasts for tomorrow show a 100% chance of a rate decrease. So according to analysts and forecasts, we are seeing a rate change tomorrow. That is not my opinion. That is what this very reputable and well-established tool is telling us. By how much, the jury's still out. Forecasts right now are split between if we're going to see a 0.25% decrease or a 0.5% decrease. Right now, about 2/3 of forecasts are estimating a 0.5% decrease. So, do we actually care? Ultimately, do we care if it does come out to be 0.25 or 0.5%? Let's break this question up. First, as a consumer, as a human being that puts money into the US economy, do we care? Not really. It does not matter. Ultimately, it's going to affect mortgage rates a little bit, but the important news isn't that the rate is lowering by 0.25 or by 0.5%. The most important thing is that the rate is lowering. That's the thing that matters, is the fact that the rate is going down. By how much? We don't care. All we care is that if the federal interest rate is going down, that means that the Fed thinks its job is done, and it's beginning to loosen its grip on the economy. Now, if you're new to Sectors Made Simple, we are an investment company. We teach the basics of investing, we create market analysis tools and strategies on how you can invest. So many people in this webinar and many people watching this webinar are investors. So as an investor, should you care? 100%. This is extremely, extremely important and will determine what happens with the market tomorrow afternoon, as well as what happens with the market over the next 1 to 2 weeks. The stock market will, without a doubt, react to tomorrow's news. Part of the reason is because investors bet. Investors put their money in where they think rates are going to land. Some people think it's going to be 0.5% and are investing their money accordingly. Some people are thinking it's going to be 0.25% and are investing accordingly. And tomorrow we find out who's right and who's wrong. So how the market reacts is going to be based on if the rate change is 0.25 or 0.5%. Additionally, because tomorrow is the second meeting of quarter 3, We'll also get an additional piece of information, which is known as the Summary of Economic Projections. We're going to breeze through this because, again, this is getting a little into the weeds. At the end of every quarter, in their final meeting, which is today and tomorrow, the Federal Reserve, or the FOMC, collects the opinions and forecasts of all of the different branch members and the governing board. They put all their ideas together, all their forecasts, and they put this in a document known as the Summary of Economic Projections. This document tells us a lot about where these key people, these key policymakers for the U.S. economy think. Things like unemployment, things like the inflation rate and the federal funds rate will be at the end of every year. So, tomorrow's rate change is likely just the first of many. The fact that they are starting to lower rates is only the beginning. But how often are they going to lower them? By how much are they going to lower them? Where do they see us by the end of this year, next year, year after that? That we don't know. But investors are putting their money, betting one way or another, and tomorrow we get to find out the updated ideas that the Federal Reserve has. So, ultimately, this report is going to be extremely valuable for investors to keep an eye on, because this is our best forecast for where the U.S. economy is headed, not in the short term of the next week or 2 weeks or the next month, for years to come. So, there's one final type of question I want to answer. Who wins and who loses if rates decrease? Let's start off with who wins. Because ultimately, I said before, U.S. consumers are overall going to be very happy that interest rates are declining. So, who wins? People that have variable rate loans. If a person has a loan and their rate isn't a fixed rate, it changes. When the federal interest rates go down, the variable rates go down as well. Again, the majority of investors are going to long-term be pretty happy. If rates are going down, company spending is going to go up. How much it costs companies to borrow money is going to go up, which means they're more likely to invest into new research and development. Company profits are going to increase as a whole. When company profits increase, usually stock prices do as well. So the majority of investors are going to be pretty darn happy that rates are declining. Also, if you are an individual that is looking to buy a car, get a student loan, or buy a house, rates declining means that you will find cheaper rates. 7.9% was back in October of 2023. So why have rates gone down since then if the federal fund rate hasn't changed? Well, because they know it's going to change in the near future. So, when those rates do decline or are expected to decline, we get better rates, which saves us money over the duration of that loan. The other side of that is companies that are looking to get a loan can borrow that money for cheaper. And then finally, anyone with a credit card. If you have a credit card, and there is even a small chance that you are not able to pay off the full balance every single month, how much you pay in interest is determined by the federal fund rate. So, if the federal fund rate goes down, your late fees and penalties are going to be less. So, who loses? Again, I said that there are some winners and some losers. The biggest group are banks. When the rates start to change, banks need to adjust, and if their balance sheet, if their assets and liabilities aren't put in the right places, this can expose a lot of weaknesses within their companies. That's a lot to worry about, though. Let's not think about the companies, let's think about the us. Where are we going to lose with interest rates declining? Well, in a lot of places that we put our cash. If you put your money in a certificate deposit or a CD account, the rates that you can get for CDs are going to go down, because all of the other rates are going down too. Same thing with your savings account or your high yield savings account. While interest rates decline, the rates that you get paid for interest in those accounts are going to go down as well. Same thing with new bond purchases. If you're buying any fixed income security or fixed rate security, rates declining means that you're not going to get as good of rates. And this one's kind of funny, but it does belong here. Inflation loses inflation loses when interest rates decline. Or rather, we lose compared to it. Because inflation is back, baby. It's ready for round 2. Remember before when we mentioned that rising interest rates, the goal of those is not to cause damage, but instead to avoid damage from inflation? Well, when you start to lower interest rates, inflation starts to creep its head around the corner a little bit and see if it's ready to come back for round 2. So the Fed has finished one part of their problem, but their job isn't done. So far, they've managed to tackle inflation without causing a recession. But now, their grip is super tight on the US economy. They need to figure out how much they can loosen that grip without letting inflation start to creep back up and causing this whole problem to start up again. We call this the Goldilocks zone. What is the right amount of interest rates so that inflation is kept low, but the economy is able to recover and build back stronger? I want to wrap things up by breaking this down in one other way. What can we and can't we expect? Do not expect the Fed fund rate to hit 0%. Dropping it to 0% is the Fed's ripcord. That is, something horrible happened, a pandemic occurred, we need to save the economy and prevent it from collapsing. They rip that cord and drop it to 0. They're not going to do that. If the economy is healthy and it is stable and it is moving in the right direction, the rate's not going to go to 0, it's going to settle somewhere. But do expect more rate cuts in the future. Tomorrow is just the start, and again the summary of economic projections will give us a better timeline for how long we will see rate changes, and a decent idea of where the Fed thinks those rates are going to settle. Unfortunately, do not expect housing and rental prices to drop immediately. Yes, we will see housing prices come down in the near future, but near future in this regard is a little bit different. The Fed has gone on record saying that they expect housing and rental prices to remain elevated for up to 2 years. So, them lowering interest rates and loans becoming cheaper doesn't suddenly mean that how much you're paying in rent is going to go down. But do expect those loans to become cheaper. If you're looking to buy a new house, if you're looking to go to college and need to get a student loan, or buy a new car, how much you pay in interest there will decline. So new loans being created will benefit from lower rates. And finally, do not expect consumer prices to decline. Certain things like food might, but the majority of this is talking about inflation as a positive number. We are settling around 2 to 3% positive inflation, which means prices are still going up. Just because we leave without a recession doesn't mean that the prices are going to go back to what they were. These, unfortunately, are the new normal, and we're only going to see the price or the inflation from here increase 2 to 3% per year. But do expect that with rising prices, we will see the stock market and many other types of companies rise. So, benefits and drawbacks all in the same hand. So let's summarize. Tomorrow, at the end of the FOMC meeting, we can expect federal interest rates to decline. And regardless by how much, this is an extremely positive sign. It means that inflation has improved dramatically, the Fed's goal is close to being accomplished, and a soft landing is well within its possibilities. This is an overall and overwhelming net positive for consumers, people that invest into the economy, and people that invest into stocks as well. Certain companies might not benefit as much, and we'll take a look at that in a future webinar with Sectors Made Simple subscribers, but the majority of companies will benefit from lower interest rates. But looking short term, how is the market going to respond tomorrow? Where is it going to lead over the next week? That's a different story. And unfortunately, only time will tell to what extent the market will react, in what way it will react, and where we go short term from here. So, you made it this far. Thank you all so much for joining us. It's been such a pleasure to get to cover this incredibly fascinating event with you all. Go over, within recent history, the first soft landing and its possibilities, and discuss how those rate changes impact everyone, from consumers to companies to investors as well. If you have any questions or would like more information about anything we do here at Sectors Made Simple, you can always send us an email at support@sectorsmadesimple.com. Thank you all so much for joining us. Hope to see you all back for another webinar in the future. Take care.